money. Miss Moneypenny. 5 types of Miss Moneypenny. So classifying levels of money. These are called money aggregates. You'll hear most of the time M1 and M2, but there's been M0 and M3, and some countries have M4. We have MZM now in the US, SA. So it does vary. Definitely important to understand what these are. They come up quite frequently in terms of the effect of monetary policy and the printing and the surpluses and everything that's going on in the economy in terms of what is available readily to spend as cash or narrow money, and then we have broad money that usually has some time deposits to it, which we'll get into. So there's different levels, usually related to how liquid the different money aggregates are, and they build upon each other. So let's get into the lesson. All right, so one thing here, it's warning. Primarily, this discussion is for the USA. Some people call it the USSA these days. Kind of a bad joke, but an even worse reality. But definitions of money supply aggregates vary by institution, country, teacher, textbook. The differences, there are very clear differences between Europe and the USA, and then there's different interpretations to them. So they are and they can vary, and they will vary. So just keep that in mind, even if everyone's, a certain group are talking about one particular country or nation, because the aggregates refer to macroeconomics for one nation's economy. It's just something to keep in mind, that they can vary. But here's the pretty much the basics for the USA. And if you do go on to read for other countries or different nations, you can get a gist for what these are going on here, and they'll give you a head start into any variations that you might find for your respective nation. All right, so let's get into our money aggregates with M0. This is a type of what's called a classification of narrow money. You'll also find here shortly that M1, so M0 and M1 are narrow money, and then M2 will be referred to as broad money, and then we'll see at M3 that's near money. So the basis for all these aggregates is liquidity. Okay, so, and we're building upon each one, because when we go from M0 to M1, you'll see that M1 includes M0 plus, just like when you get some type of SaaS product, you got bronze and gold and platinum. Well, the gold includes the bronze plus, more features, and that's exactly what happens here. So they're just building upon each other. So M0 is really literally cash and bills and notes and anything that's currency like. Anything that can be instant liquid. This is sort of just falls in line with the overall M0 being the most liquid. But for all practical purposes, it's going to be cash and notes that are physically out in the economy. So with that, we can move on to our M1, and you'll see again, M1 is narrow money. It includes M0, and it builds upon it. And the main point here with M1 is we now have deposits. So now we're putting money into an institution, a financial or a bank institution, and our physical money now becomes digital, but as you can see here, can convert to cash instantly. So this is still considered pretty much within narrow money, and obviously this makes a huge difference these days with us using digital digital transfers and credit cards more so than ever, and obviously that's only going to increase in the future, for better or for worse. It's probably both, definitely for worse. But number one, outside of the U.S. Treasury, outside of the Federal Reserve, are vaults of depository institutions that will keep hordes of physical cash. And because although they are physical cash, they're not really liquid, and they're really meant as reserves and for different parts of the economy. So while the number one factor with these aggregates is liquidity, part of it also comes down to what section of the economy. And we're kind of going from the small guy and households to larger institutions. And as you go up that food chain, the liquidity decreases and the amount of usually the asset increases as well. So they kind of run together as we go from the low MX to the higher MX. But this will include, it also includes currency. This really comes from MZ0. We have traveler's checks, which technically isn't cash, right? But you can convert them over instantly. Again, we're working off of this cash instantly. Demand deposits, right? So these are your deposits at your bank. They're not savings accounts. That's why there's always a classification. We might think that they're pretty much the same between the savings account and a checking account, because we can access both. Really your savings account is pretty liquid, but there's theoretically, if it's supposed to be a savings account, it's supposed to be over time. So that won't be included in this. A demand deposit would be your checking account, and anything that you can access instantly, the cash out of that checking account without really any reservations. And this is just sort of a catch-all, this other checkable deposits. So anything like checking deposits will be included in M1 as well, because there's no time factor to them. There's no maturity factor to them, whether it be real or theoretical. Okay? So this is narrow money. Now we go to M2, we're getting broad money. So the big thing here is you're crossing the river, and you'll hear, even though a lot of the money aggregates aren't used that much too often these days, which I'm not sure. I understand why. There's the complexities of some of the understanding over time of how the quote unquote printing of money and the surpluses and all types of other factors. They've kind of moved away from it. They even got rid of the M3, which we haven't even gotten to yet. But this is crossing over into the part where we're adding a time factor with M2. Okay, so a lot of times for those who are still talking about M1 and M2, or I should say regarding money aggregates, they usually will talk about M1 and M2. And that's because M1 is pretty much cash, and M2 is now we're starting to talk about those types of assets that have a time factor to them, so they're not as liquid. Okay, so broader set of primarily household assets that are time oriented. They convert to cash within 30 days, so they're near cash. They're pretty liquid, right? But they're not the instant liquid. And you'll notice here that this talks about household cash. And now this includes the savings deposits. Now, I was just talking about you can put $5,000 in your savings deposit account, and technically you can go pull the whole thing out. But the theory behind this is that primarily people putting money into their savings deposits is supposed to be you're trying to save, right? So if you're trying to save, theoretically you don't have the money in there for instant cash, even though you can still access it. So because the principle of that account is for longer term, that's why it falls into the M2. So there's some principle basis here. Now the second thing here, and this is important when we get to one of the later or the last money aggregate, but $100,000 or less. So we have a time deposit. So it could be CDs, or it could be any type of instrument or asset that has a time factor on it. And these are small time deposits, but they're also $100,000 or less. So again, you can see the lower money aggregate of 2. I say lower, it's kind of in between. There's an M3. Some countries have an M4. Remember, I said they vary. But this is primarily keeping this down here, because the original parts of understanding what the liquidity parts are out of these money aggregates was also within the general population, the small businesses, and your households. So like I said, number 1, it's about liquidity, but the second part there is for the non-big, large institutional entities, to exclude them from here. So again, this is all about trying to understand what layers of money are and where they are and how they get affected by monetary and fiscal policy over many quarters. This will also include money market mutual funds. Again, you can say, I can pull my money out of my money market fund instantly. I can write checks against it, yes. But the truth is most of the money that you put into money market mutual fund, you want on a longer term. So again, this falls in line with the principle, just like savings deposits, that it's a longer term target. And so with that, it falls within M2. M3, so now we get into near money. So we had narrow money, which is totally liquid, broad money, which is liquid within 30 days. These are going to go longer. So these are large time deposits that can go on for months or even years. Institutional money market funds. So now we're talking about big money, right? Now, big money isn't going to treat all their money market funds usually as cash. And so that's why this is falling within M3 and isn't so much into the money that's into the economy, into the velocity of the economy, which is how, the rate of spending money over. This would also include short-term repurchase agreements. So this is where we have like hundreds of millions of dollars, could be more, could go into billions, where let's say money market funds that have all this money, they want to make interest on it, and they'll lend it out overnight. Repos are usually just for about a day or overnight to other financial institutions, so that they can lend them that money out themselves or for their own reserves. They give back they put up a government securities or mortgage-backed securities just as collateral. They are going to be repurchased. It's a one-day loan. It's a big, fancy, complicated way for big, large institutions to get a one-day loan and they get a little bit of interest on lending out for the day. Larger liquid assets. So yes, we are using this term liquid, but because they're larger and their impact on the economy is really at a different level than the smaller guy, where things are turning over a bit more, so it's falling into the M3. And so this is where we get larger financial institutions and corporations rather than small businesses and individuals. So again, the money aggregates had 2 factors, primarily the liquidity and then the user of the money. And the lower numbers, it's individuals and small businesses. We get up here, we're talking about larger institutions. M3 was traditionally used by economists to estimate the entire money supply within an economy. It had been done for a long time. And by governments to direct policy and control inflation over medium and long-term periods. They still look at these, even though they don't. It's if you go to the Fred charts, you'll find still a Fred chart for M1 and M2, because again, those are the most common ones you'll hear. But you'll know now that there are more than just those 2, or there were. And this one they don't even track anymore. And what they've really turned into is M3's use is more often these days used as a MZM. So I don't know. There is an M4 in some places around the world. I guess they ran out of numbers, or this is a little bit of a different beast. But there is also an MZM now, which is money zero maturity. So this takes a little bit of a different take. This is all the liquid money. If you remember when we went back to the early liquid money, even with M1, with M2, we had, there was some time deposits on there, but we had under $100,000, so there was a limit. But MZM is much broader than that, and it's a broader across the economy, and it includes M2, like I just showed, less the time deposits, because we want to remove just the time deposit part, but we want to add in money markets of any size. So this one is a bit different because it's going to include all the money markets, even the large financial money markets with all billions or trillions of dollars within them, of having them be, that's liquid money. So this is a new factor, a new money aggregate that's been used more recently than M3, which has kind of fallen a bit by the wayside, at least in the USA. So with that, we will leave it at there. And until next time, I want to say thank you. And until then, be seeing you.